and welcome back to my channel. I'm Heloise Greeff, one of eToro's most successful popular investors. Today we're going to be talking about a super important topic, and that's how to think about investing during a market downturn or a recession. We've been hearing a lot about the upcoming recession, and today we're going to go through some tips, tricks and hopefully mistakes that you can avoid in the upcoming recession to make sure that you make the most of this opportunity to grow your future wealth. In the first part of this three-part series, we'll be going over some practical, tactical asset allocations that you can consider. If you like the content of my channel, please remember to subscribe and stay tuned to the end where we're going to be talking about mistakes that you should avoid in this upcoming recession. So, the million-dollar question, should you be investing during the upcoming market downturn or should you not invest? Let's unpack that a bit further. Well, the answer is it depends. It depends on multiple factors of your personal situation, where you are in your investing journey, but hopefully by unpacking the ways that we can think about investing during a recession, it'll help you decide whether it's the right thing for you or not. So let's dive in. To help us think about the investing climate of a market turndown or recession, let's take a brief refresher about the investing environment. Typically, markets go in cycles. I'm a data scientist and I like to look at data over a long period of time. So, what we see when we look at market data in this way, markets rarely repeat themselves, but we can see trends. The overwhelming trend is an upward trend. However, it is characterized by multiple cycles. Now, these cycles can depend on how far they go up and reach a peak and how far they go down. Periods of downturn are usually called contraction, and upward periods are referred to as recovery or growth. The only thing that these two have in common is that we can only retrospectively identify the absolute peaks and the absolute troughs. If you want to learn more about my tips for investing in different market cycles, I'll link my video below. Now, the other thing that talking about these market cycles doesn't address is the psychological impact that it has on investors. Typically, during a market upturn, we'll experience positive emotions like disbelief, excitement, and finally a euphoric, ecstatic excitement when it bursts into that peak. And that's sort of what we've experienced both with the recent crypto bull run as well as the last, I'd say, 2 years of fantastic market growth. And similarly, once that starts to go down, we first might experience some disbelief. There might be some false peaks, as we call it, or false troughs, where it hasn't fully reached the bottom yet, but there's a temporary upturn. Those might cause some complacency. We might feel despair, anxiety, and finally even some anger about what's happening in the stock market. And then often we're left in this lull period after this downturn. Now that can really depend how long it lasts. I'm projecting that we're going into an L-shaped recovery, which means that when recessions are said to typically last between 6 and 18 months, an L-shaped recession would typically leave us in this lull shape for a little longer, which takes us to the longer end of that spectrum, which is towards the 18-month section. So that can leave us in this depressive state for a lot longer. But when we understand the psychological impact of these cycles, we can begin to decouple the emotions that we experience with the actions that we decide to take. So we've also heard a lot about inflation recently, and inflations typically are followed by recessions. The reason why there's so much confusion about are we in a recession, are we not in a recession, are certain countries in recessions already, is because there are different definitions of a recession. A technical recession is defined as 2 consecutive periods of negative economic growth. The only thing that market analysts have recently agreed on is that inflation has peaked. So let's look a little bit at what equity performance returns usually give in the 12 months following inflation peaks. So from this we can see that since 1929, every inflation peak has been followed by either an upturn or a downturn in the 12 months following the market. But overall, there has been a positive effect in these 12 months following the inflation peaks. Now, not all of them have been positive. We can see here that there are at least two periods, 1929 and 2008, that did have negative returns. But the average return is about 11%. And so that indicates to us that there might be some relief following the peak of inflation. So the next question might be, well, how devastating will the recession be? So let's look at some more data. Here we can see that the periods directly before and during a recession almost always experience negative returns for equities. However, the 12, 6, and 2 years after recession, 82% of the time experience double-digit growth. And that's the part of the cycle starting all over with the recovery. That's the part I'm most excited about. If, like me, you were already in the stock market at the start of this, there wasn't much you can do other than focus on capital preservation. Now that inflation has already peaked, we have the recovery to look forward to, and that means we can prepare our portfolios to take advantage of that recovery. So all this talk about inflation, recession, and portfolio performance has also recently garnered a lot of attention about whether the 60-40 portfolio is still relevant. So first up, what is the 60-40 portfolio? Well, it's a classic portfolio design that states you typically invest 60% of your portfolio in US stocks and 40% in bonds. The reason this is such a classic case and garnered a lot of attention after the last financial crisis is because usually bonds and stocks are inversely correlated. This means when stocks go up, bonds tend to go down, and vice versa. So when bonds go down, stocks tend to go up. So this sort of portfolio combination tends to give you a lot of protection during the market cycles going up and down. So it's a good classic passively managed fund distribution. However, even though it has delivered over 11% of returns since the last financial crisis, it's been very good. However, in the last year, it's at a 100-year low. And that's purely because bonds have not quite performed as expected. Of course, the stock market has been going down. However, the bond market has let us down, and this has purely been due to the pressure of the quantitative easing, the strengthening of the dollar, and of course the inflation and the rise of the interest rates. So then, if one of the most classic portfolio constructions has let us down in a very critical period, that leaves us to wonder, what is a good way to construct a portfolio and how should we think about that portfolio constructions? So let's look a little bit at a framework that we can use to analyze that. If we consider on the x-axis the annualized volatility, this is essentially the amount of risk you're wanting to take. This essentially says, how bumpy do you want your roller coaster ride to be? How much bumps or kind of up and downs are you willing to accept? And on the y-axis, we have the annualized return. So of course, the most ideal place we would want to be is to have a really, really low volatility and of course maximize our returns. That's of course what we're all here to do, to increase our wealth, maximize our profits. However, the ideal scenario is nearly impossible to attain. It's the old classic saying, high risk equals high reward. And that would place us on the upper right hand corner of this image. So if we consider the 60-40 portfolio construction as a midway, classic, medium risk, medium return sort of portfolio construction, What other tactical asset allocations can we consider to see whether we could slightly nudge ourselves on this graph towards the left and perhaps even slightly up to improve our reward while we're reducing our risk? So we can start to do that by trying to try out different asset allocations. So one example might be that we trim down the stocks and the bonds and we add something else. Now that something else could be any other asset class. It could be commodities, it could be alternative assets like cryptos or carbon credits. There's lots of different options that you could consider. And those should ideally try and bring down your risk while increasing your reward. And you can see that you can keep trying different portfolio allocations. Now, of course, some people might say this is not entirely for them. They don't care about the reward, they just want to minimize the volatility. And that would put them in the bottom left hand of the graph. Examples of those might be people close to retirement. At that point in your career, you may no longer feel that you want to take a lot of risk. You just want to preserve the capital that you have and get a good fixed income from it for the rest of your retirement after you start your pension. So that would be a scenario when somebody chooses that. Or if you are like me, you have more than 30 years to retirement, you don't really care about risk, then you would potentially play in the upper right hand part of that graph, where you're saying, I am not that fussed about the risk, but I really want to try and maximize my reward because I know this is a roller coaster, I know it might be bumpy, and I've strapped myself in very well with my seatbelt, so I'm not that fussed about the bumps along the way. And that's sort of where I have been placing my portfolio. Although I would also say, I definitely immediately admit that I'm not that cool. My portfolio is more medium to moderate risk and medium to moderate return, although the pure focus is on maximizing the returns. And so that sort of leaves you with a very open-ended tactical asset allocation, and something that I have been experimenting with over the last 7-8 years since I first started stock picking. To learn more about my portfolio construction, remember to subscribe, and we'll discuss that in more detail in part 2 of this series. Let me know in the comment section whether you are increasing, reducing, or keeping your investments stable at this point. Until next time, bye now.